Okay, this video was actually recorded on September 21st, and Birkenstock ended up IPOing way earlier than I or most people expected. The reason that it took so long for me to get this video to you is because, as you can see, I redid the studio setup. I'll show you. No, I'm not moving my camera. You gotta trust me. On top of redoing the studio setup, we also ended up hiring 2 developers to work with us to increase Flank's product velocity. There's a link in the description if you'd like to join our alpha. We're starting to move very quickly, and we have a lot of exciting features coming. And thirdly, I got married. So it's been busy. With all that being said though, I actually think that this video is more important now than ever to watch. Why? Because I think we did a good job listing out some very serious concerns when we went through the company's F1, specifically calling them out for their yoga babble bullshit. If you don't know what that is, watch the video and you'll see exactly what I'm talking about. Since the dust has settled a little bit, we have the gift of hindsight. And we now know that this IPO was botched. They listed at $46 a share and slid more than 12% on opening day. So our concerns were warranted. Anyway, please check out the video. Let me know what you think. I bet you didn't know that Birkenstock was planning an IPO. After being featured in the 2023 smash hit Barbie movie as the human shoe, they are prepping to do an IPO, and in this video, we'll check source documentation to see if it's actually a buy. When a US company decides to try to list itself on the New York Stock Exchange or the NASDAQ, it will release what's known as an S1, which is the first look you get into a company's financials. However, since Birkenstock is a German-based company, they released what's known as an F1. You can see here that an F1 is for the registration of certain securities by foreign issuers, and just the keyword is foreign. What's important here is this is your first glimpse into the company's financials. And so what's big about the F1 and the S1 is the issuer is responsible for any misrepresentations or omissions. So we actually get to look at the real numbers and the real drivers behind the business. The difference between an S1 and an F1 is quite simple. The S1 is required for domestic corporations, and the F1 is for foreign corporations. UK-based ARM also is one of the hottest IPOs of 2022. And so just a quick plug for the US. I think the fact that we have foreign companies listing in the US is a positive sign for the global outlook on the American economy. Here we are in Birkenstock's F1. I think it's important because this is straight from the horse's mouth. This is as close to source truth as we can get. I haven't even looked at analysts' outlook on Birkenstock yet. I'm going right towards the source so I can get my own unfiltered view. If I get interested in the numbers, I absolutely will look at what analysts think of Birkenstock to make sure I didn't miss anything. But it's important to get an unbiased view first. And so if you'd like to pause the video here and read through the F1 yourself, it's not very long. The link to it will be in the description. I'm going to stop doing a lot of cuts here so that you can see how I actually go through this. So the first good bit of it will just be a bunch of, you'll see a lot of blank numbers, because this is just an intent to go public. That information will get filled out when the company gets closer to actually releasing their stock to the public. It's useful to see which banks are taking the company public. And Birkenstock's an old company. It's been around for a long time. And so you would expect to have the bulge bracket banks really lead this one. And you do. You have Goldman, Citi, JP Morgan, Morgan Stanley, B of A, basically all the major ones you want to see are on here. And you would expect that for a mature company like Birkenstock. That can be really helpful when you're looking at a less well-founded company. All right, I can say right now, my big concern with Birkenstock is I want to hear what their growth story is. Like I said earlier, the company's been around forever. And so we don't know how they actually plan on growing. We want to make sure that the people running the company aren't just looking for a payday. It's just going to be legal jargon until we get to the letter from the CEO. So we can see that he joined the company in 2009. I knew that Birkenstock was an old company. I didn't realize how old. They were founded in frickin' 1774. That's an old company. And their last sentence, Birkenstock is more than a shoe. It's a way of thinking. Okay. Scott Galloway, NYU professor and co-host of the podcast Pivot, basically started the WeWork disaster when he reviewed their S1 and completely destroyed it. And he used a really useful term, and I'll quote that here. And he refers to this kind of talk as yoga babble. back in 2019 when he describes the Yoga Babble Index is basically a founder and a CEO using charisma and trying to change these ideas into animate objects. In 2019, WeWork was looking to go public at a $50 billion valuation. Right now it's trading at less than 300 million. So it's a huge write down. And Professor Galloway attributes a lot of this overinflation due to a charismatic and good sales from the founder. And he goes on to say that the MDMA of capitalism is the corporate communications executive, and that when firms are still reaching for a viable business model, the temptation to go full Yoga Babble gets stronger as they're driving metrics, numbers, business model, EBITDA needs concealer. Basically, Yoga Babble is corporate bullshit. He then goes on to give an example of what Yoga Babble would be. And I think it was kind of funny. So a 1 out of 10 on the Yoga Babble scale would be him describing himself as a professor of marketing who likes dogs. 5 out of 10 on the Yoga Babble index would be I'm the big dog. And then a 10 out of 10 on the Yoga Babble index would be I'm a spirit dog that unlocks self-actualization. And then he compares other IPOs and how much Yoga Babble they introduce into their S1. Reminder, S1 and F1 are the same. Zoom, mission to make communications frictionless. Give that a 1 out of 10. 6 months post-IPO, they've returned 122%. Spotify's to unlock the potential of human creativity by giving 1 million creative artists the opportunity to live off their art and billions of fans the opportunity to enjoy and be inspired by these creators. That's a Yoga Babble index of 5 out of 10. You can see that their post-IPO price is reflective of that. Peloton's, as their mission statement is, on the most basic level, Peloton sells happiness. Well, Yoga Babble index is 9 out of 10. The stock dropped 11% in their first day of trading. Okay, moving on in their S1, they claim that they are the inventor of the footbed, leading me to question, what the fuck is a footbed? Later on in the S1, it does describe what a footbed is, so I just want to plug that here. This is jumping a little bit ahead, but it's basically just saying you have a middle support. Cool. Okay, and now I think this is an important statement. They have a section letting us know why they are going public. And they see themselves as the oldest startup on earth. Again, that's pretty high in the Yoga Babble, but sure, I like to see a culture of innovation. They manufacture shoes. I don't really like to see them referring to themselves as a tech company startup. And they're saying that the family that started that was involved in the Birkenstock family is stepping away from the company, and that it's due to a partnership, probably with a private equity company, if I had to guess. Okay, the F1 continues to go on. They talk about how the average consumer owns 3.6 pairs today. They're revamping their distribution model, growing their direct-to-consumer channel, which is a good thing. We like to see vertical integration. And they state that they have a gross profit margin of 62%, which is wonderful. Adjusted EBITDA margin of 35%. You got to be careful about that adjusted part of it. Warren Buffett famously hates EBITDA, especially adjusted EBITDA, and this can be I do not trust this number, is what I'm trying to say, but big if true. Then we get to the important stuff, their actual financial metrics. So some initial reactions I like from this. I like that they're somehow able to increase sales during the pandemic, even though it's ever so slightly, even though they're an old. So yeah, here's the acquisition, and they were able to grow revenue pretty substantially that year. That looks like about a 25% increase, which I like. That's great for an old shoe company. But we need to figure out why they were able to unlock such growth and how they'll continue to do it into the future. And now we're really into the meat and potatoes of it. So they start talking about they have a good strength of the brand. So most of their sales are coming from the Americas and Europe, and that their APMA region could be a new area of growth. However, things that I like in here are that they are investing in their direct-to-consumer business, which has grown 42% between 2018 and 2022. Another thing that I noticed when I was rereading this that I forgot to mention was they talk a lot about their design process, how they only use European leather, and they do this to create demand by having scarcity in the market. I like this. The luxury brand industry has only gone up in recent times, and LVMH has been one of the best performing stocks in the S&P 500. And so I like to see companies that try to create a more of a luxury brand feel. And that could explain why their margins are so high. Yeah, so they say at the end that their revenues have grown about 31%. They're selling more units between 2020 and 2022, and that their ASP has increased at 16% between 2020 and 2022.